Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, October 14th, 2016. So, Janet Yellen spoke today of some high pressure policies to come in the future. We'll look at what that could mean. Next week we have consumer price index. For now, I think stocks are still bullish, and we have several important sectors hitting all-time highs, while the concerns are that some of the defensive sectors are again gaining for the week. But Treasuries broke first support. I think that's an important development. We'll look at the Forex universe in more detail as the dollar strengthened pretty much against all currencies, and gold continued to be under pressure because of that. And we'll finish off with hard commodities. Oil is again at resistance, while natural gas is breaking out to fresh 52-week highs. Okay, so first, I read this article today as Federal Reserve Chairwoman Yellen spoke about some high pressure tactics. I am not sure what she means at all. Like, I read this whole article and I have no idea what she was talking about. If they're trying to raise interest rates, that's gonna be not high pressure tactics. That's gonna be, low pressure. Uh, if they're trying to print money outright, then that could be what she means. I don't know. But in any case, stocks didn't particularly like what she was talking about. So here's S&P 500 ETF SPY. So yesterday we had a gap down, but then we found support and we rallied. So we had a hollow red candlesticks. So generally speaking, hollow red candlesticks are a good sign, and it means that there is buying pressure. And then in the morning today, it was the opposite. We had stocks gap up, but then we kind of sold off throughout the day. So we formed a filled black candlestick. So we barely had some positive movement for the day, but overall it's not terribly exciting, I guess is the word. So not sure exactly what Janet Yellen was talking about, but judging from the charts, the participants of the market right now are not, I don't think they're sure what's going on. So I think if we break this support, if we close below 211, and change, pretty much everybody who has their stops, hidden below this level here will let go and will have a large selling pressure. That would most likely push the index, um, somewhere towards the Brexit low. So if this could be like a head and shoulders, and then we could say, okay, so this is about 3.5%. If we break this support here, then we could, head lower about 3.5%, would put us about the Brexit area. Alternative scenario is also very much possible, and we could easily break out of this consolidation for the past months or so and break out above 217 and head higher, which means new all-time highs. We are seeing some divergences creep into the market now. So right now I see a small divergence on the advanced decline volume. So you can see that the index itself is basically flat to slightly up. So this is more, more or less moving up from September low to now. While there is a slight divergence in the advanced decline volume line, and you can see that it was here 68,000, now it's 67,000. So there's a little bit of a divergence here. Again, those divergences are notorious for not working out. So it's possible again that we just turn around and continue higher. The market is generally bullish, and I would be only looking to go long here. Okay, here's a longer term time frame for S&P 500. Here what I wanted to show is These two indicators, this percentage of stocks above the 20-day exponential moving average and the 50-day EMA, and they're both more or less in the oversold territory. So you can see before, when we had a dip below, well, let's say 30, then we had a rally, and then another dip below 30, and another attempt at a rally. So we're there more or less, and maybe this is already, relatively oversold, and maybe we'll push higher from here. Here's S&P 500 in a weekly time frame. What I can say from this chart is we're basically retesting the breakout. So we had several attempts to go above 2134 here, 2100 or so, 2120 here, and finally we succeeded after the Brexit. But then we came down here in September, and then again we are retesting this area in October. So this is a weekly time frame, and this weekly candlestick is not particularly strong. So if the tail of the bottom here was longer, this could be considered a hammer, but this is not a hammer by any stretch of imagination. This is showing relatively strong selling pressure. So I don't think we're out of the woods yet, and I think we're gonna continue retesting these lows until we either break below them or B, hold the support. For now, we have a couple of touches in that area, and this is an important support. So like I said, if we don't hold here, we could easily retest the lows from June, July. So as far as the high beta universe, this is QQQ, NASDAQ 100 ETF. This week we hit all-time highs. These are all-time highs right here. Just on Monday, but then on we continued lower. We closed sort of in the middle of this range from Monday till Friday. So this is still showing a very good strength and participation, and the fact that we hit all-time highs actually speaks volumes, because even at this very high levels there was still quite a bit of buying interest. We pulled back afterwards, and here looking at the advanced decline lines and advanced decline volumes, I don't see any divergences. You can see that we're moving higher. Even advanced decline line, advanced decline volume lines, more or less were either flat or basically flat for the unbalanced volume. So there is not that many. I don't see any divergences for QQQ. In fact, we had several of the sectors and industry groups that hit all-time highs this week. One of them is XLK. So technology sector still very strong, and this is an all-time high right here just this week. So this is still showing strong participation. Another industry group is SMH, semiconductor, also all-time highs. And if we look at more diversified one, also all-time highs. So even diversified, very broadly diversified ETF like XSD also hit all-time highs. So again, this is showing good participation and risk appetite, because XLK, semiconductors, these are riskier groups than other groups within the market. And here's the junk bonds, also at all-time highs. And junk bonds, you can see here, I put a correlation coefficient to the S&P 500. Pretty much it's very highly correlated, 78% currently. In other words, S&P 500 correlates very highly to the junk bond market, and could be that the junk bonds are the leading indicator for this, for the stocks themselves. Is everything rosy and we can just keep buying stocks? It's possible, but I wanted to show that not everything is 100%, of course. And this week, this is the performance of major stock sectors for the past week. You can see that it was skewed towards the defensive sectors. You can see utilities, real estate, staples and basically telecommunications, they gained, well, telecommunication lost just a little bit, but basically the most defensive oriented groups are they gained for the week, while the rest of the stock sectors lost for the week. Here's an outlier as a healthcare. Now, so this just means that the consumer, the defensive groups are right now holding up the best. So it's possible that in the short term we're shifting again towards the more of a defensive posture. So this is XLP, the Staples ETF. It just showed for the week that we have gained 0.8%. So as far as the defensive sectors, that's one of them. The utility sector is the strongest gainer for the week, and it gained 1.34%. And I think this one is still holding the breakout. So we saw a breakout here, retest, and I think we're having another retest basically right now. If we hold here, we could easily rally and attempt to get to new all-time highs. This also could be viewed as a possible head and shoulders kind of formation, and if we don't hold here and actually break below them, then we could see a move for the utilities down 11% or so. So this is the height of the pattern, and we could see a move to around here, so around November, December lows. Absolutely anything is possible in the markets, and there's no way to say with certainty what's going to happen. But as of right now, I think it's still a very much a bullish chart, and I think the support for now is holding. Here's real estate. This one is not as good as utilities. You can see it kind of broke below the breakout. So right now the breakout to all-time highs has been negated. And we'll see where this goes. I think, real estate is still very much a part of the stock market. It's definitely not a part of the bond market. So if we continue, if the general market turns around continuous higher, I think real estate will certainly benefit. Finally, I want to leave you with one thought, and that is that we are entering the most bullish period of the year, historically. So this is a seasonality chart for S&P 500 ETF SPY, and this data is over past 20 years. Here we see October with this percentage of months in which S&P 500 closed higher than it opened. So 65% of the time, October was beginning of October, end of October, the S&P 500 closed higher than the beginning of October, and the average gain was 1.9%. In November, it was even higher, so we had the average gain of 1.6%, but 79% of the time over the past 20 years, the S&P 500 closed higher. So it looks like we're entering a very strong seasonality time, where we have basically stocks are very much bullish during this time period. January and February are different stories, but for now, October, November, and December certainly look like they're historically they're going to be they were higher than they opened. So that's something to look forward to, I think. Here are the bonds. This is 20+ year Treasury bond fund, the long treasuries, the most sensitive to interest rates. So I've been showing this chart and the evolution of this chart over the past few months. And here I said this is all-time highs, and I would never buy up here, so we needed a pullback. So we are basically getting that pullback, but there is now a possibility that this all-time high is as far as it's ever going to get. Maybe the interest rates are basically as low as they ever in the history of the United States bond market as low as they are going to be. This will only be known in the rearview mirror. I don't know what's going to happen in the future, but looking at this particular chart, there is now a stronger and stronger possibility of that. Especially on this Friday, you can see that, in fact, the day before, this looked like a decent, rather on Wednesday, this looked like a decent hammer candlestick, and then with a follow through next day, but it completely unraveled, and this is a very bearish looking candlestick. So we had a gap down, an attempt to rally higher, and then a push lower by the bears, and then we had a low is below the open. So we had a red candlestick with it looks like a shooting star candlestick, also fell below the 200-day moving average. So there are a lot of negatives about this particular candlestick. The important thing, I think, that we took out this low, and if you were buying, then you could put your stop right below this low. But there is still quite a bit of support. Like, for example, there's support down here, there's support down here. So maybe the support will be found, and maybe we'll get another rally. But if they are indeed going to be raising interest rates in the near future, this could be this could be it for the interest rates. So they will, in other words, interest rates will be going up and bond prices will be going down. I'm not yet 100% prepared to call that, but it's possible that this indeed was the height of the bond market. Here is a TLT on the weekly time frame, and I put in this automatic support resistance. So basically we had a breakout right there above the previous peaks, continuation to all-time highs, and a normal retest. I would still consider this a normal retest. A bounce higher, but then it got sold pretty hard, and looks like we broke below support, below this low, and we closed below support. So even you can see that this is a weekly candlestick, also looks very bearish. So it's possible that this is it as far as the bond market is concerned. I mean, this is a vertical advance, and it was not sustainable by any stretch of imagination. So again, we'll see if we bottom out or not, and then maybe continue higher. But for now, this looks like a chart I would avoid, honestly, at this point of the game. On a more diversified universe, the AGG, this one doesn't look particularly, well, doesn't look as bad, because you can see that we're sort of consolidating in a flat manner, and this support has not been broken. Like, for example, from September, the low from September 13th has not been broken, but here the low from the September, whatever, 13, 14 was already broken, was a close below it. So AGG is more diversified, there is more corporate bonds in it, and this one doesn't look as bad as TLT. So this one I can say still that it's possible that this is a bullish chart. However, if we look in the weekly chart, also we have a close below the recent lows, except if we ignore this big spike down, we had a close below the recent lows. Depends on where we draw our support and support lines. We can move this support line down below the recent lows, then we're still consolidating in a sideways manner. But we'll basically at this point of the game, I just say let's wait and see. And here way back when I pointed out this pattern here, and we had a breakout and a move higher. So we had exactly this pattern, well, even more, a little bit more duplicated on the upside. So sometimes they work out really well. All right, moving on to the Forex universe. This is United States dollar index on a daily time frame. So that dollar index this week had a very strong move. Basically, in most of the week it was moving up, closed near the highs. definitely broke out of this consolidation. I pointed out this consolidation between 96 and change and 94. We definitely broke out of this consolidation to the upside. Now, as always, it's possible we're going to come down and retest this consolidation, or we could just, retest this level now, because it looks like we also broke out above 97.62. So we have possibly we broke out of two levels here. If we are going to, successfully retest this level, most likely what's going to happen is we're going to move up slightly higher, then come down, and then retest this level, and then most likely move higher. I'm bullish on the dollar index in general. Next chart I'll show on the longer term time frame. This is the weekly chart of the US dollar index, and these are the couple of past weeks. We had two strong candles, and that's the level I was showing you just a second ago, 97.62. That's the level right there. And we just closed above it at 98 even. Again, this is possible we're going to be retesting them, because it will most likely depend on the euro, especially if the euro decides to take a strong dive, then this breakout will hold and continue higher. We'll get to euro in a couple of minutes, but the first thing I wanted to show is British pound. Last week, this was kind of like a mini flash crash of some sort, and it crashed really strongly, but came back up. So again, for the week, British pound lost another 1.37%. I kept saying that this is a bearish chart. If you look at some of my previous videos, we had this outside reversal here. This candlestick right there was engulfed by this white candlestick with a follow through, and here I thought, maybe we'll get a rebound to this level, to like 138 and change. We didn't even get there. We had a feeble bounce. It got sold at $1.34 here, and then just unraveled completely. Anyways, bearish security, so difficult to pick bottoms. Of course, you can see that most likely this is going to, what is it, 14%, so most likely this is going to be, yeah, about 15%. So it looks like this pattern, maybe this was a bear flag, so maybe this pattern is now complete, and not sure what's going to happen, but again, now we're most likely going to rebound and test these levels at $1.28, kind of like that, and then we'll see if that holds or if we continue higher. Japanese yen, I think basically we have held support. So in other words, Japanese yen is not gaining against dollar. So we have multiple attempts to break lower, rejections here. The lower prices were rejected. By the way, this is a weekly chart. I kept pointing out the same chart, multiple videos. You can look it up. But the past 3 weeks we're moving strongly higher, and we're basically attempting to break out of this high here, out of this high. So I think the yen has reversed and most likely is going to start losing against the dollar. In other words, a US dollar will gain versus the yen. Okay, and here's the euro versus the dollar. On the weekly time frame, this is, in my opinion, clearly a bearish chart. We had a big drop, couple of attempts to go higher, but maybe this was it. And now we're kind of want to go lower. So like, if imagine if this was a 1 minute chart, I would want to short this chart, because we had a big drop, attempted rebound, rejection, short, attempted rebound, rejection, short. So maybe we'll get another spike higher, but maybe that was it. Maybe this spike right here from March of this year, maybe that was it. Because especially if we break this lows here at 109 and change, we could easily retest the lows from last year, November of last year, and from March of last year. Here's the daily time frame for euro. Again, since the weekly time frame is bearish, then I would be looking to short this chart as well. We had one support level that broke right here and another possible support break, because it looks like we broke it, but then we rallied here on Friday. So I'm not 100% yet if this level was taken out, and now we're going to attempt to retest this lows here from July. To summarize, the dollar is bullish, and I think this will weigh on gold, which we will discuss next. All right, I got lots of gold charts for you. So first of all, I thought this was possibly a bull flag. So this is a handle. We had a sideways consolidation, triangle consolidation. So I had here before lower highs or a bull flag question mark. Now I can definitely say that this was not a bull flag. This, because of this big drop here, this whole bull flag thing was completely negated. So now we have lower highs and a lower low relative to this low, at the very least. So where is this going? So again, if we just go by this low, which is a 1252.80, we did close below it here on 7th October, which was 1251.90. So we did close below that low, and this low was technically taken out, and actually we had a spike below. But many times the support is not hard, and it's a support zone. So it looks like there were several spikes here, and buyers did step in here at this low prices, because this is a relatively low risk entry. If you think about, if you put your stops here down below 1243, then it's not a big loss if you take this loss. And the bigger issue here is that there's a possibility now that we're already in a bear market, back in a bear market for gold. And I'll try to explain what I mean in the next few charts. So first of all, this is the level I'm talking about, 1300. We had a couple of touches here, 3 touches, and a breakout. Breakout, consolidation, one attempt, one retest, bounce higher, and then a complete and utter break of this level. So this level 1300 did not hold at all. And this is not what the gold bulls want to see. Obviously, they wanted to see a couple of retests and a bounce higher off of here. Then this bull flag would be correct, indeed correct. So we had breakout, consolidation, and then bounce higher and a breakout above this level, but it did not occur. So right now what we're dealing with is a first support break. A major support is down here, so anything below, if we take out 1201, I'm almost a guarantee we're back in the bear market, and we'll most likely start taking out low, fresh new lows. Here's a longer term time frame. This is a weekly time frame going back to 2012. One of my proprietary indicators here is gold breadth index. For now, it's showing a bullish posture, but honestly, I'm not 100% on it right now because of this strong pressure. And as I said before, the dollar is really gaining strongly, and this is a dollar versus the gold, and you can see that there is a consistently strong negative relationship between gold and the US dollar. Occasionally we get a foray into the positive territory where gold and dollar are moving in the same direction, but generally speaking, gold and dollar move oppositely to one another. And we're getting to that right now. Again, we had this, small foray where gold and dollar were moving up together, but now I think we're getting back to normalcy. And if dollar continues higher, gold can just easily unravel. Here are the concerns I have. The biggest concern I think I have for G comes from the gold miners, because there's more data that can be extracted from gold miners, namely the advanced decline lines. So first of all, I pointed out this bearish divergence actually a day before it happened. It's sometimes really bizarre. We had a series of higher lows and then a series of lower highs. In the advanced decline lines, unbalanced volumes, and advanced decline volume lines. So this divergence really worked out, and gold miners dropped further. We have now a bigger divergence. If we look at this low versus this low, you can see that this low is lower, it's 21.94, here is higher, 22.50, so it looks good, right? If we look under the hood, so to speak, of this ETF, this is GDX, you can see that this low here, or I meant to say this low at minus 28.65 is higher than this low, which is at negative 28.79. So this is more negative. And then here, the same thing goes for the advanced decline volume. This low is minus 36.17, and this low is more negative at minus 38.31. And the same thing goes here for unbalanced volume. This low here is 144, and this low here is 133. So we have all three indicators are pointing to another divergence, which is a bearish divergence. So it's possible we're going to again break this low and head lower. If we head lower, let me go to about 10 month. These are all-time lows here at about 13 bucks, and if we head lower, then we could easily completely unravel and be back, towards those lows. I think the biggest concern I have, of course, is a fact that this is a bullish percent index, percentage of stocks on the point and figure buy signal within the gold miners ETF, and here it dropped below. It dropped to 17%. So only 17% of the stocks within the index are on the point and figure buy signal. This is very low, and this could be already pointing to a bear market in gold miners and by extension in gold. So right now, honestly, I would say that you could risk, because the risk here is pretty low most likely, so you could buy here and just put your stop here, but you can notice that pretty much everybody does the same thing. So you can see those big gaps. So you have to account for those gaps if you decide to trade GDX. In other words, you have to size your position accordingly. In other words, on the lower side. By the way, if you sign up for MasterCharts Trading, you get all of this information, and you get a nice spreadsheet, Excel spreadsheet, which tells you how to size your positions. Just to briefly, same thing as I showed for gold. This is a gold breadth index, same thing. Only this final breakout was confirmed by the gold breadth index. Again, for now, I guess I could say I'm bullish, but I am very concerned about the divergences and the bullish percent index that I just showed, which is potentially already in a bearish territory. Finally, for GLD, here is another divergence. You can see higher low on GLD, but the lower low on the unbalanced volume. This is a divergence. Sometimes they work out, sometimes they don't work out. If this divergence works out, then we could easily be back below these lows here, which implies a bear market. Moving on to the world of hard commodities. This is light crude oil, West Texas Intermediate, on the daily time frame. Here we're basically back at resistance around $51, 51.67. Here we're in the resistance zone. If we break out above this level, you can see here on the weekly time frame, then possibly we could be back in the bull market. I would be kind of reluctant, honestly, to buy, to buy in the idea that oil could go to, I don't know, $100. I just don't see it. I mean, American producers can outproduce pretty much anybody on planet Earth, including Saudi Arabia. So I'm not sure that oil is really going to be significantly higher from here. Plus, we're clearly at resistance. So this resistance here from multiple touches of this area around $50, maybe even slightly higher. Maybe there's a little bit of resistance there. So this already here we had a resistance here that was reaffirmed, and we had a move lower. We'll see, where this goes. But you can see that already there were quite a bit of selling here this week. Moving on to natural gas. Very bullish chart. 52-week highs. If you listen to my previous videos, this is a daily time frame. I turned bullish around here when we had a breakout above this resistance, and this is a major resistance area. I'll show in the next chart what I mean. So, bullish chart and 52-week highs. I mean, last week I said same thing, that we could pull back, but we didn't. We just kept moving higher so far. So this is the chart I'm referring to, $2.50, breakout, retest, successful retest, continuation higher. So at this point, we're basically closing this gap, and most likely there's going to be some selling here because of the resistance from this area, like around here, around $3.57, 56 or so. The reason for that is because this pattern here, this pattern right here with this breakout above this pattern. So the breakout came from around here, and we could see that the depth of this pattern is around, I would say, maybe, well, let me think about it, from here till here, maybe 18, maybe 19%. So a breakout from this level, another 19%, which will put us exactly where I just pointed out. So I think that some selling will come in around there, and we'll see where natural gas goes. Finally, I wanted to show corn. This is an interesting chart. Could be that the support has held for corn. We had this big hammer-like candlestick, continuation higher, and a strong gain this week, 4.5%. So it's possible. Maybe we're bottoming out. Maybe we'll kind of move sideways and then break out higher. It's difficult to say. Anyways, if you have any questions, please don't hesitate to send them in. Please consider signing up for MasterChartsTrading.com and stay tuned on how to find us on the internet. Thanks a lot. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the success as trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trade alert services. Bye-bye.